So, if you're an income investor, you've probably always heard that bonds are the safe part of your portfolio, right? So, why do they sometimes feel like anything but? Well, today we're going to pull back the curtain on those invisible forces that make your stable investments go up and down, and more importantly, what you can actually do about it. You know that feeling, right? It's a tough one. You open up your statement, you're expecting everything to be nice and steady, and whoa, the value of your bond portfolio has dropped. It's really unsettling, and it makes perfect sense to feel concerned when that happens. That is the big question we're tackling today. We're going to demystify what's going on behind the scenes and give you the tools you need to navigate this stuff with a whole lot more confidence. Okay, let's dive right into the core concept. We're going to call it the seesaw effect. And honestly, if you get this one idea, you're most of the way there to understanding how bonds really work. So, the official term for this whole seesaw thing is interest rate risk. All it means is that when interest rates out in the world change, it can either ding the value of the bonds you already own, or it can affect the future income you'll get from them. And this shows the seesaw in action perfectly. Just imagine you own a bond that pays you 3%. All of a sudden, the Fed raises rates, and brand new bonds are being sold that pay 5%. I mean, think about it. Why would anybody pay full price for your old 3% bond when they can get 5% on a new one? They wouldn't. So for anyone to buy yours, its price has to drop. That's the seesaw. But here's where it gets really interesting. It's not as simple as rates go up, bonds are bad. As an investor, you're actually caught between two totally different opposing risks. It's a constant balancing act. Okay, so first up is price risk. This is the one you feel. It's that immediate drop on your statement, that paper loss that happens when interest rates climb. It's not a realized loss until you sell, but boy, it sure feels real. Now, on the other side of that seesaw, you've got reinvestment risk. This is the sneaky one. This happens when rates fall. Sure, the price of your bond looks great on paper, but when that bond matures and you get your cash back, you've got to put it to work again at the new, lower rates, and that means less income for you down the road. And this table just lays out that trade-off so clearly. Look at this. When rates rise, yeah, your current bond prices take a hit. That's a negative. But your future income potential goes up because you can reinvest at those better rates. And when rates fall, it's the exact opposite. Your prices look great, but your future income gets squeezed. See, you can't totally escape it. And this is just a fantastic point from an expert. For anyone who's investing for income over the long haul, those rising rates, the ones that cause that short-term price pain, they're actually an opportunity. It's your chance to lock in a higher cash flow for years to come. Okay, so you're probably wondering, how do I actually measure this risk in my own portfolio? Well, that brings us to a super important tool that every bond investor should know about. It's called duration. The easiest way to think about duration is like this. It's a risk ruler for your bonds. It's a single number, measured in years, that gives you a really good estimate of how much a bond's price is going to move if interest rates change by 1%. So, let's make this real. Imagine you own a bond fund, and you look it up and you see its duration is 5 years. What on earth does that actually mean for your money? Well, it's actually pretty simple. If interest rates were to go up by 1%, you can expect the value of that bond fund to drop by about, you guessed it, 5%. So the rule is, the higher the duration number, the more your bond's price is going to swing around when rates change. And this chart just makes it crystal clear. That same 1% increase in rates, for a short duration fund, it's a little bump, maybe a 2% dip. But look at that long duration fund. It takes a much bigger hit, a full 10% drop. Now, longer duration usually means a higher yield, so again, it's always a trade-off. All right, enough about the problems. Let's talk about solutions. Now that we know how to spot the risks and even measure them, what are some of the practical, real-world strategies you can use to manage everything? One of the absolute classic strategies is building what's called a bond ladder. Instead of dumping all your money into one bond, you split it up. You buy bonds that mature in different years, 1 year, 2 years, 3 years, and so on. As each rung on your ladder matures, you reinvest that money. If rates went up, awesome, you get a higher yield. If they went down, well, only a small piece of your portfolio is affected. It smooths everything out. But here's a really important warning. It's so tempting to just play it super safe and buy only short-term bonds. The problem is, when you do that, you're cranking up your reinvestment risk.
If rates fall, you're stuck constantly rolling over your money into worse and worse deals. You see, balance is always the key.
So, beyond just laddering, a few other fundamentals are really your best defense. Don't put all your eggs in one basket. Spread your money across different maturities, short, median, and long, and spread it across different kinds of issuers, like governments and corporations. And maybe the simplest rule of all, match the bond to your timeline. If you know you need that cash in 3 years, buy a bond that matures in 3 years.
Okay, so let's pull all these ideas together. What's the big picture here? What does it really mean to build a portfolio that's not just ready for one thing to happen, but is genuinely resilient, no matter what interest rates do?
Well, one key decision is whether you're using individual bonds or bond funds. Individual bonds feel so safe, right? Because you know you'll get your money back on a specific date. But, as our source material calls it, that can be a psychological illusion because it hides that reinvestment risk. Bond funds, on the other hand, handle all that diversification and reinvesting for you automatically, but their price is going to bounce around more visibly. And this right here might be the most important takeaway of all. Trying to guess what the Fed is going to do or where interest rates are headed, it's a loser's game. The real goal is to build a portfolio with a structure that's so well balanced, it doesn't need you to be a psychic. It's about being resilient, not about being right. So, I'll just leave you with this one question to think about. When you look at your own income investments, are they built on a bet that rates are going to go one way and not the other? Or have you built a balanced structure that's ready to handle whatever comes its way? The answer to that question could really make all the difference.